What truly fuels that relentless innovation?
Hmm.
The kind that creates staggering wealth like
Mhm.
we see in places like Silicon Valley. What really drives that constant, almost like feverish pursuit of the next big thing? And maybe more importantly, what happens when that drive, that hunger, crosses over into just pure speculation?
Yeah, it's a huge question, isn't it? It really sits at the heart of so much economic progress, but also, so much volatility. Is it always this like linear march forward driven by genius?
Right.
Or is there something more cyclical, maybe even predictable about these periods of, explosive growth and then the inevitable, often painful correction?
Exactly. Understanding those human elements and the market dynamics is just crucial, I think, to making sense of it all.
And maybe even figuring out how to navigate, our own investments today.
That's the core tension we really want to explore today. And a prime example, I think, of someone who just embodied that relentless pursuit is our subject, Jim Clark.
Jim Clark.
Yeah.
Yeah.
He's often described as this enigmatic, really influential figure, a high school dropout who somehow turns himself into a billionaire. He founded these pivotal tech companies you've definitely heard of.
Yeah.
Silicon Graphics, Netscape.
Right. Huge names.
His story isn't just, a biography. It feels more like a masterclass in the relentless pursuit of change, of innovation. He really shaped Silicon Valley.
He absolutely did. And Clark's journey, it's not just about his personal success or, how much money he made. It's a really powerful lens for looking at that whole transformative era. His almost pathological impatience, people said, and his complete disdain for mediocrity. It didn't just drive him to get rich. It made him constantly challenge everything, always looking for the next disruption. He had this really unique, often kind of confrontational entrepreneurial spirit.
And central to understanding him and that whole time period really is this concept we'll get into, the new thing.
The Michael Lewis book title.
Exactly.
Yeah.
From Michael Lewis's book about Clark, it defines this notion that's always sort of poised, just waiting to be taken seriously in the marketplace. It's this idea that's just a tiny push away from general acceptance.
And when it gets that push,
Bam! It changes the world. It's a constant reinvention, that belief that something truly revolutionary is always just around the corner.
that's it. It's about foresight, sure, but it's also about the raw courage, the conviction to act on that foresight, even when maybe nobody else really gets the potential yet.
Yeah.
The new thing, it isn't just some tech advancement in a vacuum. It's a concept that captures the collective imagination, right? It becomes the engine for a whole market reorientation, pulling capital, pulling talent along with it.
So our mission today is to take you on this journey into that world, the extraordinary life of Jim Clark, the dot-com boom he helped ignite, and hopefully some timeless lessons about innovation, market psychology, and that elusive search for lasting value.
Yeah, we'll explore that drive of a visionary entrepreneur, but also contrast it with those broader, sometimes, let's face it, irrational forces of market speculation and just basic human nature.
It's going to be a wild ride, I think, through Silicon Valley's most transformative and, yeah, sometimes turbulent years.
Buckle up.
Okay, so let's unpack this a bit. Who was Jim Clark? This figure who, as sources put it, sent fantastic ripples through the world. His story starts about as far from Silicon Valley glamour as you can get.
Oh, absolutely. He really came from nothing. The accounts paint this picture of, growing up poor, facing real adversity, dropping out of high school.
Right.
Yet despite all that, he somehow forges this path that leads him to make, what, $3 or $4 billion?
It's incredible.
That contrast between his origins and his eventual success is just, it's almost unbelievable. It really speaks to some kind of powerful inner drive.
And those early struggles, they really did seem to set the stage for his later ambition, didn't they? He gets expelled from high school, which, ironically, leads him to enlist in the Navy.
Right. Not the typical path to tech billions.
Not at all. But it was there, surprisingly, that his talent for math, for complex problems, was first discovered. But what's really compelling, maybe a bit unsettling, is the motivation sources point to. They say his deepest drive was fueled by this profound desire for revenge against earlier humiliations he'd suffered.
Revenge. Really?
Yeah. The anger about the shame he felt at sea apparently quite literally propelled him forward, not just in the Navy, but later in the business world. It wasn't just about money for him. It was about proving something, overcoming, maybe even dominating.
Wow. That underlying anger, that need for validation, it becomes this incredibly potent engine for his later achievements. It's a powerful, maybe slightly dark example of how personal, emotional stuff can drive huge economic shifts.
Yeah, it shows innovation isn't always born from, pure curiosity or altruism.
Definitely not.
What's also striking about Clark, especially when you think about today's startup mythology, is that he was kind of a late bloomer as an entrepreneur.
Yeah, that's a good point.
He didn't really start his journey until he was 38, which totally challenges that common idea, that you had to be some 20-something kid in a dorm room to found a successful tech company.
Right, the Zuckerberg model isn't the only model.
Exactly. The research calls his path an extraordinary leap. From 38-year-old unsuccessful college professor with a warning label on his forehead to a founder of a multi-billion-dollar corporation.
That narrative gets lost sometimes, doesn't it? In the glorification of the young disruptor. Clark's story shows that accumulated experience, perspective forged through frustration, and just knowing what's next can be way more valuable than just youth.
He was ready for that leap because of his frustrations, maybe,
I think so. He had these insights built up over years.
and his personality. Sources paint this incredibly vivid picture. He's described as restless and constantly driven to change things.
Mm.
They even call him an unhappy optimist, which is fascinating. It suggests his achievements came from this deep-seated need for change rather than contentment.
An unhappy optimist, I like that.
Yeah. And there's this great phrase, you didn't interact with him so much as hitch a ride on the back of his life.
Wow, that says a lot. Like a force of nature.
Totally. Sweeping others along. He had this disregard for the past, found it boring, apparently, and was just relentlessly focused on the future, on what could be.
That restlessness, that future focus was absolutely key to his genius and, yeah, his success. He wasn't sentimental about past wins or losses. He was always looking for the next problem, the next frontier, the next...
The next new thing.
Exactly. It made him dynamic, maybe difficult sometimes, but undeniably a force. That inability to be content, that need for motion, it propelled him.
His first ventures really show this drive. Let's talk Silicon Graphics, SGI.
Early 80s.
He co-founds it, and it wasn't just another computer company. The core was the geometry engine, this revolutionary chip he created that just transformed computer graphics and design.
Yeah, that was huge.
It wasn't just like a small improvement. It enabled things like the modern special effects you saw in movies like Jurassic Park. It's a whole new standard.
The geometry engine was a marvel. It allowed real-time processing of complex 3D graphics at a speed and quality nobody had seen before. It wasn't just movies either. It changed how engineers in aerospace, automotive, how they visualized complex designs. Huge impact from the start.
But what was really radical about Clark's approach, even when SGI was flying high, was his philosophy of self-cannibalization.
Explain that.
He genuinely believed that for a tech company to survive, it needed always to be looking to destroy itself. If it didn't, someone else would.
Wow. So actively undermining your own success.
Pretty much. It meant being willing to disrupt your own successful, high-cost products with lower-cost alternatives, especially to compete with PCs. He was trying to avoid what we now call the innovator's dilemma.
That was incredibly prescient. So many companies still struggle with that today, right? The innovator's dilemma, where successful companies can't bring themselves to disrupt their own profitable products.
They stick with what works.
Until some smaller, nimbler competitor comes along with something cheaper or different and just eats their lunch. Clark understood you had to disrupt yourself before someone else did. He was willing to be the disruptor, even of his own stuff.
But even with that vision, he eventually left SGI.
Right. Why was that?
Sounds like frustration with management he saw as too cautious, too complacent, people like Ed McCracken. For Clark, it was part of his endless search for some unattainable solution, that restlessness again. He couldn't handle inertia. And that dissatisfaction led him straight to the internet. He just saw its potential, comparing it to the PC back in 1985, this global force waiting to be unleashed.
His foresight there was extraordinary. He saw the internet not just as tech, but as this platform that would eventually connect all the people on Earth.
Yeah.
And that realization led him to partner with Mark Andreessen, this young student who'd created the Mosaic browser.
Yeah.
And together they founded Netscape.
Which just exploded. It basically made anarchy respectable, democratizing the web, catching giants like Microsoft completely off guard, forced them to pivot their whole strategy to the internet.
Totally reshuffled the deck.
And the Netscape IPO in '95, just a watershed moment. It catapulted Clark into the billionaire class, obviously, but it also generated wealth at this insane speed for early employees.
That's the crazy part.
Get this. An engineer joins Netscape in July '95, and by November, just 4 months later, he's worth $10 million.
Wow. 0 to 10 million in 4 months. That just fundamentally changed the game in Silicon Valley, showed this unbelievable speed at which fortunes could be made online, left a lot of traditionalists scrambling.
It's interesting, too. Before Netscape, Clark had this earlier vision for a telecomputer,
A telecomputer, what was that?
sort of merging computing and TV, like a futuristic home hub. It didn't quite take off as he envisioned, but the industry's focus just pivoted so fast. Everyone at once realized that the next big thing was not the television set, but the personal computer hooked up to the internet.
Right, the PC became the center, not the TV.
But interestingly, his early presentations for that telecomputer, they actually contained ideas that became foundational for the internet boom.
Yeah.
Things like e-commerce, email, digital services.
So even if the specific product didn't hit, the underlying ideas were sound. The internet just provided a much better, more scalable platform for them to actually flourish.
Shows his ability to pivot, to adapt his vision.
Absolutely key. He didn't just stick to one failed idea.
So Clark's relentless pursuit didn't stop with Netscape. He had billions, this reputation for disruption. Where did he go next?
Healthcare, a notoriously change-resistant sector, right?
Definitely. His next ventures really cemented his unique approach, his risk tolerance. Take Healthion.
Which became part of WebMD later.
Right. It aimed to streamline the paperwork generated by the American healthcare industry, a massive, inefficient $1.5 trillion market back then.
Huge opportunity, but also huge complexity.
Sources say it was initially chaotic and apparently strategically rudderless. But the IPO, it popped 400% in opening, even when the broader market was down.
That really shows Clark's force of will, his reputation. Despite the chaos, his willingness to put it at great risk, investing his own money heavily to influence skeptical VCs, showed his conviction.
His personal investment created this mimetic effect, you mean?
Yeah.
Others jumped in because he did.
Exactly. Fear of missing out on whatever Clark, the visionary, was onto.
He also launched My CFO, his last big one.
Yeah, designed to help the mega-rich manage their complex finances better. Consolidating data, providing personalized advice, challenging the traditional banks.
So again, spotting disruption potential, even in established industries like wealth management.
He kept finding these new things where others didn't see them.
And his hiring philosophy was legendary too. He looked for committed people, calling them pigs, not just interested ones, the chickens.
Right, the old pigs and chickens analogy. The pig is committed, bacon. The chicken is just involved, eggs.
He had this method. When they come by to apply for the job, I tell them, we're all confused here. We don't know what we're going to do yet.
Brutal honesty, or maybe a test.
But when you find someone you want, I tell them, here's exactly what we are going to do, and it's going to be huge, and you are going to get very rich.
It's brilliant psychologically. It filtered out anyone looking for security and attracted people who thrived on uncertainty, who wanted the big vision, who were willing to go all in, like him. Ensured he had a core team of fully committed pigs.
His investment philosophy was just as unconventional. After Netscape, he's sitting on $1 billion in shares.
Financial freedom like few people ever experience.
And what does he do? Sources say what pleased him was to put it at great risk, not play it safe. While VCs typically sprinkled their money around, diversifying.
Clark went all in.
He famously said, I know how to make a lot of money in the future, and since I know how to make a lot of money in the future, I'm going to put all my money on it. Likened to betting all in double zero at roulette.
That level of concentrated risk is almost unheard of. It came from this supreme, maybe irrational confidence in his own foresight. It must have terrified more conservative investors.
And his personal obsessions were revealing, too. He built this massive computerized yacht, the Hyperion.
Ah, yes, the super yacht.
Packed with 25 SGI workstations and myriad other electronic gadgets. A floating tech marvel. But the irony,
What happened?
its maiden tests in the rough North Sea were apparently plagued by calamity and technological chaos.
Oh, the irony. A perfect metaphor, almost. This symbol of ambition and advanced tech succumbing to the very chaos it was meant to conquer.
Exactly. It shows that blend of vision and the messy reality of innovation. Even the cutting edge runs into problems.
A humbling reminder. But his drive wasn't just about tech or money, was it?
No, his ambition wasn't purely financial. He was constantly trying to outdo rivals, explicitly saying things like, I just want to have more money than Larry Ellison.
The Ellison rivalry. Classic Silicon Valley.
His goals just kept shifting. Each achievement fueled a new target. It seemed driven by this constant need for validation, proof.
It really underscores that for guys like Clark, wealth isn't just an endpoint. It's a metric in this ongoing game, right? A way of keeping score against rivals. It feeds that need for perpetual change that defined him. Less about the money itself, more about the win.
Okay, so now let's widen the lens. How did Clark's intense personal pursuit of the new thing connect with those broader, almost feverish market trends of the late 90s? How did those two things collide to create the dot-com boom?
Yeah, this is where it gets really interesting because the whole investment logic got turned completely upside down.
How so?
Well, traditionally, right, a company convinces people to invest by showing profits, cash flow, a track record.
Makes sense.
But in this new thing economy, it flipped. A company convinced people to invest first, often based on just an idea, a concept.
Again, hope the profits would follow somehow.
Exactly. Hoped they'd follow, maybe years later. IPOs changed fundamentally. They went from being a reward for past success to being the tool to fund future innovation, often for companies with zero revenue, let alone profit. It was all about the company of the future, not the present.
Which created this lottery ticket mentality for investors.
Totally. This widespread belief in instant riches, the whole model shifted from seeking steady returns to chasing this tantalizing shot at a 1,000% gain based purely on a concept, a .com name.
You'd hear those pitches. IPO at $20 could hit $100 day one, $200 in 6 months.
The potential upside felt so huge, so life-changing, it just sucked in enormous amounts of capital, overriding any traditional logic.
And that feeds right into the fear of missing out, FOMO.
Oh, absolutely. FOMO was maybe the most powerful motivator of that whole era. The pressure to jump in was immense because the winners weren't just making millions, they were making billions. In months.
Not years or decades.
Right, so it fueled this irrational rush into investments that, looking back, just defied any normal valuation metrics. The collective delusion was powerful.
Howard Marks, in his memo bubble, drew these really striking parallels to a famous historical mania.
Ah, the South Sea Bubble, 1720.
Exactly. Puts the dot-com boom in this humbling context.
It's an incredibly useful historical lesson, and yeah, the similarities are genuinely eerie. The South Sea Company starts out with this seemingly noble goal, help the British government with its war debt.
Okay.
In return, it gets this vaguely defined trade monopoly with Spanish South America, demand for the stock surges purely on expectation of future profits that never really showed up. Then in 1720, boom, speculative mania grips the nation. The stock goes from $128 in January to over £1,000 by June, just vertical, based on hype.
Wow.
But the crash was just as fast. By September, same year, the bubble bursts. Stock plummets 80%, back below £200. The speed, the scale, feels very familiar.
And the famous story involves Sir Isaac Newton, right?
Yeah.
Master of the Mint, arguably one of the smartest people ever.
Yes. He actually sold his shares early, recognizing it was pure speculation. Famously said, "I can calculate the motions of the heavenly bodies, but not the madness of the people."
But then,
Tragically, even Newton wasn't immune. He saw everyone around him making fortunes, felt that pressure, got sucked back in, bought at the absolute top, and lost £20,000. A huge sum back then. It's this stark reminder that even the most brilliant minds can fall victim to market mania and social pressure.
and Marx points out these almost identical parallels between the South Sea Bubble and the dot-com era. First, that greed is good ideology was rampant.
The idea that private vices, avarice, pride, luxury produced public benefit.
These sound familiar. Same rationalization we heard in the 90s.
Exactly. The pursuit of individual wealth, however questionable, gets framed as good for society overall.
Then there's the undefined business models. The most notorious bubble company from 1720 was for carrying on an undertaking of great advantage, but no one to know what it is.
Chillingly perfect echo of the dot-coms, right? I don't understand what it does, but just give me the stock symbol.
Yeah. The concept, the potential, completely overrides any logical assessment of revenue or business plan.
It's collective suspension of disbelief.
Plus that circular valuation logic, people seriously argued the higher the shares rose, the more they were actually worth.
Right. No person can purchase at too high a rate since his profit will increase in proportion to the price he gives. Total delusion.
It's the exact opposite of fundamental value, where price reflects worth. Here, price became worth. A self-reinforcing loop. totally detached from reality.
And the greater fool theory was everywhere. People buying shares knowing that their long-term prospects were hopeless.
Since they aim to get rid of them to others more credulous than themselves, you buy hoping a bigger fool will pay even more.
Classic sign the market's disconnected, it's just musical chairs, and eventually the music stops.
There was a poem from the time, a South Sea ballad. Few men who follow reason's rules grow fat with South Sea diet. Young rattles and unthinking fools are those that flourish by it.
Meaning the big, quick profits often went to the reckless, not the rational.
A timeless observation, sadly. In manias, it's often the unthinking or reckless who win big initially, which just encourages more bad behavior.
And finally, just like the dot-coms, there was this total societal obsession. The name of the South Sea Company was on everyone's lips, creating fortunes, leading average people to quit their jobs to speculate.
Just like taxi drivers becoming day traders in the late 90s.
That pervasive nature, drawing everyone in, is a hallmark of these big bubbles. Common sense goes out the window.
Okay, but here's a crucial counterpoint. That whole changing the world narrative. Industries expected to change the world often do, but investing in them doesn't guarantee profit, right? Why is that?
It's such an important distinction for investors. How do you separate revolutionary impact from a sustainable, profitable business? Take RCA.
Radio Corporation of America.
Leader in the revolutionary radio industry in the 20s. Stock goes from $8.27 to $114 and $29. Amazing rise.
Yeah.
Then the crash hits. It plummets to $2.50 within 3 years. And even 25 years later, it hadn't recovered even a third of its peak value.
We're looking at the graph now.
Yeah.
Yeah, vertical rise, then steep, prolonged fall. Radio did change the world, no question.
Right.
But RCA as an investment, a disaster for many.
Precisely. And Warren Buffett makes a similar point about aviation and automobiles. Both industries changed the world, absolutely. Transformed travel, commerce, daily life.
Undeniably.
Yet Buffett notes almost all of the manufacturers of both are now gone, and the airline industry. From its start through 1992, its cumulative profit was zero.
Zero. After all that world-changing impact.
Zero. It highlights that critical difference. Societal impact does not equal investor returns.
So Buffett's key isn't about predicting societal impact at all.
No, he put it so clearly. The key to investing is not assessing how much an industry is going to affect society, but rather determining the competitive advantage of any given company, and above all, the durability of that advantage.
The moat.
Exactly. The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors. That moat, whether it's brand, tech, cost advantage, network effects, regulate, that's what matters for investors more than just being in a revolutionary industry.
But that's what bubbles often completely ignore.
Yes.
Right? They focus on the revolution, not the sustainable moat.
Precisely. A sobering truth from the South Sea bubble to the dot-com crash.
So what did this all mean for the people caught up in it? The employees, the everyday investors. How did this intense speculation impact lives, especially in Silicon Valley?
Oh, the impact was huge and often devastating. The internet revolution drastically altered lives. Sources talk about thousands becoming online traders, often with little indication that they have any idea what makes companies do well or stocks go up.
Like that guy trading only CMGI stock for 5 months without even knowing the CEO's name.
Exactly. Pure speculation, zero understanding, shows how deep the lottery mentality went.
And the effect on careers and education was profound, too.
Yeah, business school applications were flat or down, fewer people taking the GMAT. MBA students were actually dropping out after the first year to jump into hot tech fields.
Wow.
Investment banks, usually the top destination, struggled to recruit. There was just a tsunami of people chasing a pot of gold in tech. It pulled talent away from everywhere else.
Created this massive talent drain towards the dot-com promise.
Totally. Reshaped career paths for a whole generation.
And the venture capital world itself got warped. We hear about eye-popping returns from mid-90s funds, like 235% a year for the top 1994 fund, average of 45%.
Sounds amazing.
But the median return that year was only 22.5%, and a quarter of funds actually lost money.
So the headlines were skewed by a few huge winners. The reality for many VCs was much more ordinary, even negative.
Right. And the outlook for VC became questionable because there was just too much money for too few ideas.
Classic supply-demand issue.
Which strengthened entrepreneurs' negotiating positions and forced VCs to compete in haste to make investments, often at inflated prices, just to deploy all that cash flooding in.
Think about the numbers. $7.8 billion committed to VC in 94 when returns were okay-ish. By 98, fueled by those crazy outlier returns. Over $26 billion committed.
Its capital chasing past returns, flowing almost blindly into an overheated market.
Creates that self-fulfilling, unsustainable cycle. More money inflates valuations, making it even harder to get good returns later.
The IPO mania was really the peak of it all, wasn't it? The mania within a mania.
Absolutely. IPOs became seen as the ticket to easy money. The average new issue in 1999 jumped something like 160% above its issue price on day one.
Insane. And the Akamai example is just unbelievable.
Tell me about Akamai again.
Goes public at $26 in October 99, closes day one at $145, market value, $13 billion.
And
14 months earlier, it didn't exist. At the IPO, it had lost $28 million on $1.3 million in sales. Yet its market cap eventually hit $29 billion, completely unmoored from reality.
a $29 billion valuation for a concept, essentially. Wild.
And there was that theory that companies were intentionally underpricing IPOs to create that first day pop, that buzz.
Right. To make future stock sales easier, help founders cash out higher later. If Akamai's $145 closing price was right, they left nearly $1 billion on the table selling at $26. Suggests hype generation was part of the strategy.
Which points to this deeper issue, right? The IPO became less about raising capital responsibly, more about creating excitement and liquidity for insiders.
Raises serious questions about due diligence, about what happens when lockup periods end and founders or VCs dump their 80–90% stakes. What happens to the price when supply suddenly increases 10 times?
It was a ticking time bomb.
And it shifted the goal entirely. Cashing in used to be the result of successful company building. Now it's often the end in itself. It's the IPO that's the thing.
The focus shifted from building a business to just getting public.
Which led to that valuation parameter vacuum. Internet companies had negative PE ratios, no earnings. So analysts relied on things like price to sales, Red Hat, trading at 1,000 times revenue.
Crazy metrics.
Many were just concepts. Their stocks truly slipped the valuation moorings.
It's completely backwards. In the old days, investors figured out how the business was doing and then set the share price. Now, the share price itself seemed to dictate how well the business was doing.
A dangerous feedback loop where sentiment becomes reality. And the actual riddle of profitability was huge, especially when so many internet offerings were free.
Right, like the greeting CEO saying, charging for cards was a small idea. Giving them away is a really big idea.
Sounds good, but
Marginal cost of adding a user is near zero? Great. But the marginal revenue is exactly zero. It's that joke. I lose money on everything I sell. I make it up on volume.
a funny way to put a painful problem. The path to actually making money was often unclear or non-existent. And many business models were just impractical. Virtual inventories, need huge warehouses like Amazon.
Or Webvan, the grocery delivery service, lost $95 million on $4 million in revenue. The costs were just unsustainable.
A financial black hole. And the established players didn't just roll over.
No way. Merrill Lynch, Albertsons, Kroger, Toys R Us, Walmart, they all moved to defend their businesses, launching their own online efforts.
Which hit the dot-coms hard. eToys stock dropped 70% from its high, wounding up billions in value because of competition from traditional players going online.
And even among the dot-coms themselves, competition was brutal.
Little differentiation, right? No patents, no real barriers to entry.
So competition was mainly on low price, and consumers could always find the lowest price instantly online. Profitability was elusive, maybe transitory at best.
Any advantage got competed away almost immediately.
So inevitably, the music stopped. What was life actually like in Silicon Valley after the crash in 2000, when the bubble burst?
The fallout was significant and really personal. Rampant jealousies and recriminations. Working relationships poisoned when people found out execs had secretly hedged their stock while employees lost everything.
Ouch.
Banks suing former darlings. High flyers just vanishing. Employees were scarred by the collapsing value of their stock options. Some lost their homes as housing prices fell.
Devastating. And the psychological toll.
Immense. This seeming randomness of success and failure. Tales of incompetent people getting rich by luck while competent neighbors went bankrupt. Younger engineers felt angry, cheated out of the quick wealth their elders got, and maybe scornful of those who lost it. Just bred resentment and disillusionment.
But the national economic impact, while severe in tech hubs, was relatively limited overall.
Thankfully, yes, because non-tech stocks weren't nearly as overvalued as, say, in Japan's 1990 crash. That provided a buffer, prevented a total meltdown.
And afterwards, a big shift in attitude.
Huge shift. Investors became much more cautious, gun-shy. Capital for startups dried up significantly. Even giants like Microsoft had to raise dividends to attract investors in that new, skeptical environment. The game had changed.
Which brings us to a really important question. Faced with all that volatility, boom and bust, what actually sustains businesses and people long term, beyond the speculation?
It's critical because there's that stereotype of the ruthless, step-on-anyone entrepreneur.
Right, profit above all else.
But sources argue that real entrepreneurship isn't amoral. Building something significant, something that lasts, should involve considering values how you operate, how you treat people.
And maybe it's the only way to survive long term anyway.
Exactly. The market eventually figures you out. There's this really insightful set of values from the Native American community, 7 principles that seem pretty universal for guiding entrepreneurs.
Okay, what are they?
First, bravery. Courage to see an opportunity, but also to deal with the inevitable discouragement, defeat, just to keep going.
Makes sense.
Vision. Guiding the planning. Seeing past limited resources to the full potential. Seeing the mountain.
Respect for self and others.
Yeah.
Appreciating your own effort. Relating to others. Motivating your team. Essential.
Trust. Absolutely indispensable for marketing, for building relationships with employees, customers, vendors. Overcoming mistrust.
Honesty. In finance, managing assets, staying calm and rational amid chaos, avoiding deception.
Generosity. In directing operations, supporting and leading people. Eliminating bias. Fostering collaboration.
And finally, fortitude. That inner strength to keep the business resilient comes from persistence, realism, consistency, fight scattered thinking, temptation to quit.
These values all point to a deeper truth. An entrepreneur's most valuable possession is not money or products or facilities, it's his or her reputation.
Because if you lie or cheat, the market finds out, right? You lose credibility.
Absolutely. But if you're guided by these kinds of values, you build credibility, build trust. People want to do business with you. It creates a sustainable cycle.
It's about avoiding that new thing trap, maybe.
Yeah.
Getting so caught up in the hype.
That you fail to see and appreciate what actually sustains the business long term. These values provide that true north when the market's going crazy.
So we've traced this incredible journey, Jim Clark's restless, chaotic pursuit of the new thing, reshaping Silicon Valley. We've seen the euphoria, the pitfalls of the dot-com bubble, and the human side, ambition, ego, but also the need for enduring values.
And that core paradox, right?
Yeah.
The drive for innovation, like Clark's, is vital for progress, for wealth creation. But when it crosses into unbridled speculation, ignoring fundamental value, that leads to massive wealth destruction, real hardship. The line between vision and recklessness is so fine sometimes.
Especially when the market loses its mind. It leaves us with this final thought, maybe something for you, the listener, to reflect on. In a world that's always chasing the new thing, always looking for the next disruption, how do we balance that necessary audacity, that risk-taking, with those timeless principles of long-term value, both financial and, maybe more importantly, human? What's your new thing that truly lasts?